Hello, and thank you for joining us today for this Edward Jones webinar, our 2023 Market Update. My name is Sandy Miller. Before we get going, let me highlight a few of the features on your screen that we're going to be using. On your screen right now, you should already see a video window with me inside. There should be another window with our presentation slides and a third window for our Q&A feature. If for some reason you have any difficulty during the program, you can click on the help icon at the bottom of your screen. That's the black question mark inside the yellow circle. This is for any technical questions you may have. We also have a team on standby ready to assist you if at any time during our discussion you have a question or would like clarification on a point. Just click on the Q&A icon, which is the third button from the left at the bottom of your screen. That will allow you to send in your questions. We'll do our best to answer your questions in the allotted time we're given. If your question is not answered, please follow up with your Edward Jones financial advisor. If you do not have an Edward Jones financial advisor, please click on the Find an FA widget below. We also have a lot of helpful resources and information available for you inside the Resources icon, which is located next to the Q&A icon. And for those who wish to utilize it, closed captioning is available and can be turned on or off at any time during this webinar by clicking on the closed captioning icon. All right, now that you know your way around, let's get started. After a challenging 2022, markets have staged an impressive recovery so far this year. So what is driving the market rally, and are the fundamentals of the economy justifying the move higher? Joining us today to provide insight on those questions and a look ahead is Edward Jones Senior Strategist Angelo Korfakis. And Angelo, thank you so much for joining us today.
It's my pleasure, Sandy. As you mentioned, we recently closed the books on a historically strong first half of the year, with the S&P 500 almost up 16%. Despite lingering inflation pressures, geopolitical concerns, high interest rates, and worries about an upcoming recession, markets have climbed the proverbial wall of worry. Two of the biggest headwinds for markets last year were inflation and Federal Reserve policy. These factors have started to turn favorably, while the economy has remained remarkably resilient. Inflation, as measured by the Headline Consumer Price Index, or CPI, has been cut by more than 2/3 since it peaked a little over a year ago at 9.1%. And the recent readings show that price pressures are now slowing across a growing number of categories. This progress in inflation provides some breathing room for the Fed to soon end its hiking campaign after taking rates from near zero to around 5.5%. In addition to the improving macroeconomic backdrop, excitement around artificial intelligence and its impact on the economy and corporate profits have boosted the technology sector, which carries a large weight in U.S. equity indices. We can come back to this point, but to answer your question about whether this move higher in stocks is justified, we think that there are some good reasons why stocks have worked on erasing last year's losses. However, it might be a bit premature to sound the all clear, as the delayed effects of Fed tightening filter through the economy gradually.
On this point, is the economy immune to higher interest rates, and do you still see a recession or economic softening ahead?
So far, consumers have kept the economy out of recession, even as other cyclical areas of the economy, such as manufacturing and housing, have been in contraction. We can point to three unique post-pandemic conditions that helped boost consumer spending. Number one, accumulated savings over the past 3 years, and consumers have been dipping into those. Number two, pent-up demand for services like travel, restaurants, etc. And number three, a tight labor market with job openings exceeding the number of unemployed. These conditions that have helped the consumer power through higher inflation and interest rates are still present to a certain extent, but their support is lessening some. in a rolling recession scenario where weakness in specific sectors is offset by strength in others, potentially offers a foundation for overall growth to stay positive. On the blue bars, you can see growth over the past 4 quarters. And on the yellow bars, you can see the consensus estimates for the next 4 quarters. The economy is expected to slow, with GDP potentially stalling but remaining positive. It is possible that just as consumption becomes less supportive, the slump in manufacturing and housing may start to reverse. And we have started to see early signs of that.
As we think about the rest of 2023, what will be, in your view, the prevailing macroeconomic conditions that investors should expect?
Sure. We see 3 key macro themes for the remainder of the year. The first theme is ongoing disinflation. Basically, we think that the improvement that we have seen on the inflation front will continue. Headline CPI could hover around 3% for a while as the benefit of lower commodity prices is now behind us in terms of the easy year-ago comparisons. However, core inflation, which excludes food and energy and is what the Fed focuses on to set policy, will continue to ease in the months ahead, helped by potentially lower used vehicle prices and further easing in housing costs. The second theme we are looking for is the end of the Fed's rate hiking cycle. The Fed has done a lot in a short amount of time to bring inflation back to its 2% target. And even though we are not there yet, policy is now restrictive and inflation is coming down. Historically, the market has responded positively to a pause in rate hikes. However, we should note that we don't expect the Fed to cut rates this year, which is probably a 2024 story, as policymakers don't want to repeat the mistake of the 1970s when they declared victory prematurely. The one caveat to the positive takeaways from the first 2 themes is that along with the slowdown in inflation and a Fed pivot, we are likely going to see a slowdown in growth. A potential soft patch likely lies ahead, which could trigger some volatility. Nevertheless, we think that the foundation for a new bull market has been formed.
Now, given the conditions that you described, Angelo, what are the opportunities for investors in today's market?
Let's stick with the magic number 3. Despite the market's hefty gains, we see an opportunity to, first of all, diversify into the lagging segments of the equity market that carry lower valuations. Number 2, an opportunity to dollar cost average to take advantage of the potential for higher volatility. And number 3, the opportunity to extend duration within the fixed income portion of portfolios. Let me touch on each one of these. First of all, broadening of market participation. Up until recently, market leadership has stayed very narrow, with just a handful of mega-cap technology stocks accounting for the majority of this year's gains. Beyond the largest 7 S&P 500 companies by market cap, gains are more modest. We, therefore, see an opportunity to rebalance as appropriate and diversify into these lagging segments of the equity market that carry lower valuations. These include value-style investments, small-cap companies, traditional cyclical and defensive sectors, and international stocks. Next, the opportunity to dollar cost average as potentially volatility picks up. As time passes, we think that the impact of higher interest rates will be felt, and growth could weaken some. As we mentioned, buffers like the pandemic savings and a strong labor market remain, but volatility could make a comeback. Nevertheless, the strong first half of the year has historically been associated with further gains for the remainder of the year. To avoid trying to time the market and to take advantage of the potential for volatility, we recommend investors dollar cost average by investing systematically at regular intervals, spreading out their purchases and buying more when prices pull back. The third opportunity we see is to extend duration within the fixed income portion of portfolios. With inflation continuing its downward path and with the Fed preparing to end its rate hikes, we think that last year's peak in bond yields will likely hold. Yields are historically attractive across the yield curve, providing great opportunities for investors to generate income in cash-like instruments and also longer-term bonds. We see an opportunity for investors to complement their shorter-term bonds with longer duration fixed income that have a longer maturity and higher interest rate sensitivity. These bonds not only offer the opportunity to lock in the historically high yields for a longer period, but also may appreciate if yields start to move lower as economic growth softens and the Fed starts cutting rates down the road.
Here's a question that's top of mind for many investors. With CD and short-term fixed income rates the highest in more than a decade, why be exposed to stock and bond market fluctuations?
That's a good question, Sandy. No doubt this is a great environment to generate income. As the Fed has been hiking rates aggressively, yields have surged, boosting the attractiveness of CDs and other cash investments. However, the attractive yields are not as risk-free as perceived. In many cases, investors are locking in a very low return in real terms because current short-term rates are largely matching or are only slightly above the rate of inflation. But investments such as equities that have growth potential may help combat the effect of inflation over time. Investors should also be mindful of the so-called reinvestment risk. When a CD or a short-term bond matures, yields could be lower than they are today. In this case, the return principal could earn less in a new security. And one last point, which is a good one to end with. Over the market history, higher risk has equated to higher reward, and we don't expect that to change now. This is reflected in our assumption that equities will outperform bonds and bonds will outperform cash over the long term, with the latter being a drag on investment performance most of the time. For perspective, since 1928, cash has outperformed both bonds and stocks over the course of a calendar year just 13% of the time. And the only 3 times that cash was positive while both stocks and bonds were negative was in 1931, 1969, and last year, 2022.
Angelo, thank you for your time today and for sharing with us this great insight as we look ahead to the remaining months of 2023. As I mentioned earlier, we have several resources that we hope will help you during this time. Be sure to check them out by going to the resource icon on your screen. We're now going to start the Q&A portion of the program. We have a team of subject matter experts waiting online to answer your questions through the Q&A widget. Please remember that there will not be any video during this portion. You will only see a slide prompting you that the Q&A is now in session. Rest assured, the webinar is still live. We will do our best to answer your questions during the allotted time. If your question is not answered, please follow up with your Edward Jones financial advisor. If you do not have an Edward Jones financial advisor, please click on the Find an FA widget below. I also want to remind you that this broadcast will be available again on demand using the same link you used to register for today's program. Please note our upcoming webinar as well. Thanks again for joining us, and please enjoy the rest of your day.